Hey everyone, Mark Hart here from MIP Capital Partners, together with our CEO and founder, Matt Sinclair. Today we're going to talk about tax benefits. As many of you already know, real estate investing is one of the most tax advantaged asset classes out there. And fortunately, there have been some new changes to the laws that have dramatically increased the tax benefits that investors can receive immediately. Today, we are going to break down what those changes are and then let investors know how they can actually participate and get the maximum benefit of those taxable losses immediately. The benefit of MIP Capital Partners BTR Fund 3 is that we are going to make sure that investors will be able to receive those benefits and a significant portion of those benefits in the calendar year 2025. So we're going to break down what that actually looks like for investors, and most importantly, how that impacts and increases the return on investment as well as the cash on cash return to investors. Now, in the traditional sense, as you may know, the depreciation, straight line depreciation, allows you to deduct the value of the home less the land over 27 and a half years. While utilizing strategies such as a cost segregation study and now 100% bonus depreciation, that allows you to dramatically accelerate those losses. And instead of taking the average over 27 and a half years, you can take the vast majority of those losses in year one. When you take those losses, we're going to dive into a little bit later, that can dramatically increase your tax benefit. And there's certain investors that will make real estate investments for the tax benefits alone. The large change that just happened this year in 2025 was thanks to the One Big Beautiful Bill, is that now 100% bonus depreciation is now permanent. In the past, it was phasing down. There was a lot of uncertainty about if investors were going to receive that for the future. And fortunately, now we have clarity. So savvy investors are able to take on this benefit, which is an opportunity of a generation.
The incremental financial impact of the revised legislation is significant. So with the prior legislation, investors have been watching the bonus depreciation expiration schedule tick down, which created artificial timelines for real estate acquisitions. So on the left side of the page here, you can see the prior bonus depreciation phase out schedule. With bonus depreciation now being permanent, this provides certainty that facilitates long-term tax planning, which is highly beneficial for investors and businesses. And on the right side of the page here, we've put together just an illustrative example to show the incremental impact to the same illustrative hypothetical real estate transaction of the new legislation versus the prior legislation. So as you can see, for this hypothetical $1 million property that is placed in service in 2025, there is an additional cash flow of over $60,000 just because of the bonus depreciation has gone from 40% to 100% in 2025. And again, that's purely incremental. It's in addition to what was already there from a cash flow perspective. And critically, this additional cash flow is gained without risk taken to achieve it. It's by the book per the updated laws.
All right, here is an example $100,000 investment of Class B shares into our Fund 3 opportunity. And what I want everyone to focus on is going to be highlighted in blue at the bottom right-hand corner. And the first number to focus on is going to be the internal rate of return. You can see how excluding tax benefits, that internal rate of return is projected to be 13.9%. However, once you include the tax benefits, because of this 100% bonus depreciation and cost segregation studies, that increases to 22%, and the average cash on cash pre-tax benefits is 7.4, but that increases to 10.5 once you take these tax benefits into play. So it's extremely important as real estate investors the first question I highly recommend you ask when you're looking at other investment opportunities is to say, will I be receiving the tax benefits? Are there tax benefits at all? Because not all opportunities are treated the same. With our Fund 3 opportunity, that answer is a yes, and we're going to make sure that you get the maximum amount of those benefits as quickly as possible, and the vast majority are going to come in the calendar year 2025. Now, before when I said some people will actually make investments based off the tax benefits alone, here's a really good example of what that math actually looks like. So this is assuming that you invested into Fund 3 with a $100,000 investment, and let's say your tax rate is at 35%. We focus on what's in bold as well as what is highlighted in blue on the 35% tax column. A $100,000 initial investment from LPs and from investors. We're projecting a 2025 calendar year taxable loss to that limited partner of over $69,000. As you think about investing, it's roughly 69% of your investment we are projecting is going to be a taxable loss in the very first year. Next, you're going to take your applicable tax rate, in this example 35%, and multiply that by your taxable loss of the $69,000, and that is going to get your estimated tax shield in that specific year of $24,000. One way to think about this is this $24,000 is capital that you otherwise would have had to pay the government, but you now get to keep in your pocket. Thus, if you take that true savings of $24,000, divide it by your investment of $100,000, that is a 24% cash on cash return in the very first year. And that is one of the most conservative ways to do the math at the end of the day, because this is not taking into account any projections. We're not taking into account future cash flows, future appreciations. This is what you have some of the highest certainty to be able to acquire as an individual investor. Now, of course, we are not CPAs. You have to have the disclaimer. Highly recommend that everyone's situation is going to be different, and we recommend that you reach out to your CPA as well. But fortunately, we have reached out, to our CPA to break down these numbers and make them as accurate as possible.
So this is a summary of our scenario analysis where we compare the base case, upside case, and our credit case. And there are some key takeaways that I'll walk you through. So firstly, you'll notice that across the scenarios, the cash on cash returns are the same. And that's because even in the credit case, we're able to make our distributions to limited partners in each and every month throughout the entire forecast period. Another key takeaway is that even in the credit case, the IRRs to limited partners are still favorable, considering the relatively low-risk nature of the deal. And a final takeaway is that the tax impacts are substantially beneficial. I worked with a real estate-focused accounting firm, one of the better real estate-focused accounting firms nationally. Spent about a month building out the tax analysis from a financial modeling perspective to ensure that we were properly and thoroughly capturing all the tax impacts in somewhat conservatively, to be frank. The two bottom sections of this page show the IRRs across the scenarios. And I think that the biggest takeaway here from a tax perspective is the comparison of the tax adjusted IRR versus the unadjusted IRR. 100% bonus depreciation has a significant impact from a time value of money perspective. That's why the tax adjusted IRRs are substantially higher than the IRRs excluding tax benefits. And again, we've rigorously evaluated this, spent a lot of time and effort ensuring that it is accurate and, to the letter of the law, making somewhat conservative assumptions. But you can see the updated legislation has a dramatic effect. So this page shows the tax adjusted IRRs by share class at different tax rates and the corresponding capital gains rates for both a 1031 sale and acquisition scenario and a scenario where the sale occurs without a 1031 exchange. And again, just to be completely intellectually honest and transparent, we wanted to show both scenarios side by side. The tax benefits are meaningful especially for individuals in higher tax brackets. I think one key point here, the 100% bonus depreciation makes the return on investment from pursuing cost segregation studies substantially higher. And cost segregation studies allow for the partitioning of the real estate components to effectively utilize bonus depreciation to hyper depreciate the real estate subcomponents to generate the large passive losses to the benefit of the investors. So it is somewhat technically complex if done properly. And I think it is important to ensure that if an investor pursues these types of tax treatments, that you work with highly experienced and qualified financial and accounting professionals to make sure that it's done in accordance with the laws. So this page shows how we've arrived at the average annual tax adjusted cash and cash return metrics for each share class by tax rate. You can see that the impacts of bonus depreciation create significant tax adjusted cash flow benefits in calendar year 2025. As Mark alluded to previously, the 100% bonus depreciation has a significant impact in the near term. And so as you can understand from a time value of money perspective, as the IRRs indicated, this is significant. But that's why you can see that for the 2025 column on the left, the yields are substantial, what we're calling cash and cash returns. The updated legislation regarding bonus depreciation has meaningfully increased the tax benefit to investors, and the timing is opportune with this investment to capitalize on the tax benefits for the calendar year 2025. Because significantly with bonus depreciation, unlike certain other types of depreciation, with bonus depreciation, irrespective of when in the year the investment's made, like when the asset's placed in service, the owners, in this case it's the investors, the limited partners, receive 100% of the annual benefit of that bonus depreciation. So that alone is significant, and I think it could be quite meaningful for individuals looking from a tax planning perspective for 2025.
Now, one of the biggest questions that we receive from investors is, can they do a 1031 exchange because they already own an asset that they've owned for many years? It's gone up in value. They're selling that asset. Can they do a 1031 exchange directly into our Fund 3 opportunity? Unfortunately, that answer is no, because the Fund 3 opportunities, investors are actually acquiring shares or units of a company, and that is not considered like-kind exchange for the IRS guidelines of a 1031. Fortunately, there is another route that is still very beneficial because of the 100% bonus depreciation that just got put into place this year. And what investors are doing is they're going to, instead of doing what's called a 1031 exchange, they are still going to sell that asset that they've owned for many years that has gone up significantly. They will sell that particular asset, and then they will invest the proceeds into our Fund 3. And then with Fund 3, we are going to do the cost segregation study, the 100% bonus depreciation, and are projecting to get 69% of the initial investment as a taxable loss in the calendar year of 2025. So that investor that sells their asset that they've owned for many years, they can use the passive losses from the Fund 3 opportunity to apply and offset the capital gains from their rental property, and that can dramatically reduce the amount of taxes that investor could be forced to pay in this individual year. Again, please reach out to your CPA to make sure that it does, apply to you. However, we're very fortunate that we have many investors that are going down, with that strategy. So if any of this resonates with you and you'd like to discuss more about the tax benefits, as well as potentially seeing if the Fund 3 opportunity would be a good fit for you and your family, please reach out to myself. My contact information will be available. If you need assistance with accountants and CPAs, as a real estate investor, we highly recommend that you have one that focuses on real estate investments and really understands these tax benefits and how the tax laws change. We can be more than happy to get you those referrals as well. And hey, hope to hear from you. Thanks, guys.